Hi, my name is Mickey Fritz, and I'm going to show you how you can pay off your home fast, faster than you ever can imagine, using the HELOC strategy. But here's the thing, let's also pay off all of that personal debt that you have too. We're going to include everything, and I'm going to show you exactly how it works, exactly how it's better to run it this way, and how you will save your money as well. So HELOC stands for Home Equity Line of Credit. Here's how it's going to work, and here's how I'm going to give you this what if scenario. So first, let's start with the mortgage, okay? So we're pretty much just identifying that this mortgage balance that we want to pay off is $524,580, 6.5%, 30-year term, and you can see that the principal and interest payment is $3,327. In this example, we are saying that the estimated home value for this property is $750,000. What's great about the HELOC strategy is that when you go for a first lien position HELOC, that's very specific that I'm saying here, you can get 80 to 90% of this home value. So in this example, we're going to say we got 90% awarded to us. So for this to make sense, you must know at 90% of this 750, we can be awarded $675,000. First lien position HELOC means we are going to replace the mortgage. We're going to break free from the mortgage. So this amount is going to pull that mortgage in. And now your HELOC, just the HELOC, has the balance. We have enough room to do that. This bottom number here is that difference after we consolidate it. And this $150,000 of equity, we're going to use that to pay off the other debts. So let's build the scenario. We're going to also say that this family in this what if example also there's all of that consumer debt, vehicle loans, from medical loans, credit cards, just like pretty much a normal person. We are also identifying that debts are not expenses. So we are actually going to account for personal expenses to live their lifestyle, from food all the way down to miscellaneous, and estimating that 201 for however much else they're spending. So in total, their expenses for lifestyle is $3,811, but we're not forgetting they also have to pay for their debts. So here's when the HELOC strategy comes into play. We identify that their net monthly income is about $14,798. And then when we add all of the expenses, all of the debt together, they are paying $7,555, okay? So remember, we replace the mortgage with the HELOC, and there's our updated balance. And I just wanted to show you that we're also going to say this HELOC has a rate of 8.5%. And then we're going to add this little caveat. We're going to say the rate is going to go up 0.5% every single year, no matter what's the behavior of the HELOC strategy. What we want to do is treat our HELOC just like a checking account, just like a savings account. So when we get paid our income, it will go into our HELOC every time we get paid. And then when we need to pay our bills or expenses, we will pull it out of our HELOC, and then we'll pay off our expenses. We will leave the difference of this amount into the HELOC. What makes the HELOC strategy so great, and the HELOC itself, the product, that it's open-ended. We can deposit money in and withdraw money out freely during our draw period. We can also have a draw period up to 10 years, 15 years, 20 years, or even their HELOC products that exist for 30 years. So what's the result? If we run the strategy that way, money in, expenses out, and we repeat that even at 8.5% and the rate going up, we will get the total property paid off, this balance, in how fast? That's right, we'll get it paid off in 9 years, okay? And then we'll get incredible savings. Mortgage interest saved, $393,000, right? And then cash flow savings. So that means we paid off the home. We are accounting for the principal and interest for the years that we no longer have to commit to a mortgage. Look how much that adds up to. That is life-changing instead of paying the bank. 9 years is great, but stay with me now. Remember I said we're going to pay off the home and all of the debts. And let's see, if we choose to do that, will it give us a better result? Let's take a look. So all of the debt that we have here is totaling about $100,519. let's not forget, we have access to the equity after we rolled in our home, and we have access to $150,000, okay? So we're gonna use that money there to consolidate the debt. So 150 consolidates that total debt of 100,519. So if we do that, we're changing the numbers. And I want you to pay attention to these changes here. This is the original numbers of just paying off the home in 9 years. But if we make that consolidation, here are the changes to the plan. Our total balance goes up, right? Because we consolidated all of that debt into the line of credit. What also changes, if the balance goes up with the consolidation, that means our total expenses goes down. Why? Because we no longer have to pay that debt to those lenders. It is all now included to the HELOC. But does that make sense? Does that give us a better result? So let's take a look. Our income now goes in to the higher debt. Our expenses come out to pay lower expenses. And if we run it that way, we will now get not only the home, but all of the debt paid off instead of 9 years, 7 years. Woo-wee! Those are exciting results, but I'm pretty sure someone is sitting down listening to this video. They're thinking, well, how much does it cost? And they're believing, since it's a HELOC on a variable rate going up, it costs us more. Let me show you the truth based on the behavior of how much you're paying. So let's break this down. Before we consolidate, we have a principal and interest payment right there displayed. We also have debts, and the total amount with those monthly obligations also displayed. When you add that together, here is what we're willing to pay and we feel comfortable with, right? We're used to doing it this way. But my suggestion was to consolidate, and we're measuring, is it a better plan, and are we saving month to month based off obligation to run it this way? So let's break this down with more detail. So over here, we have our total line of credit, as you can see, and here's the behavior of 1 month run this plan, okay? So we're gonna get half of our income in the beginning of the month. And remember, we said we're gonna deposit our income into our line of credit, just like a checking account. So if we go from this amount, getting paid and depositing it, you can see here, the balance goes down. Beautiful. We get paid again, and then we're gonna deposit that income into the line of credit once more. The balance goes down. We get to the end of the month, there's our expenses. And let's assume we're using our credit cards to swipe for our expenses, right? Earning some cash back, earning some points. So we're gonna pull this money out of our line of credit, just like we would a checking account. Please remember, a home equity line of credit is open-ended. Deposit money in, withdraw money out. So when we do that, we withdraw money out, you can see the balance goes up. So how much does that cost us? We're adding everything up at average daily interest at 8.5% through all of the changes. If we add all of that up, how much are we paying? Here it is, right here. We are paying $4,147.89. But how much were we paying running it the old way, the way that we're taught to do it? You wanna see? Here it goes. $6,280 is the old way, but in the new way, month to month, we are only paying $4,147. There you have it. It's cheaper to run the HELOC strategy way. I would rather pay the lesser amount. So in that example, that means we have more money left over to us, and we're going to choose to intentionally leave the money into the line of credit so we can lower that balance for that next month and rinse and repeat and make it cheaper and cheaper every single month while lowering that balance and paying it off in 7 years. This is how I paid off my home. This is how I paid off all of my debts in 5.5 years. I encourage you to learn more, and where you can learn, right here, okay? So I can teach this to you, watch all the videos, or go into that favorite spot that we love you to go so you can get resources available to you so you can continue to learn how you can become debt-free famous. Bye-bye.